Welcome to the Team Duplicity channel. So yeah, we want to thank the realtors and business partners, Jeanette, for joining us. And we kind of just set this up because in this market, there's a lot of people, especially with COVID the last few years, who have been, let's say, self-employed, um, and may not have a full 2 years of tax return showing enough income to qualify. And I've really been seeing a lot of this lately, where I'll get a couple years tax returns, and we as lenders have to average over the last 2 years normally, for self-employed borrowers, and sometimes the income's not there. So there are some other options out there. That's Archie looking to go out. There's some other options out there that Deep Haven, who is the investor here that's going to be making this presentation, has for us, so that we'll have some, as a realtor, you'd have some good talking points. So if someone says, hey, I'm self-employed, there's no way I can get a loan right now, I've been told that. That may not be the case. So there's some different options through the bank statement program and debt to service coverage ratios and asset depletion programs, that can kind of make up where the conventional mortgage don't. So with that said, are there any questions prior to starting? Great. If not, we'll let Catherine Parcell and Aaron Enright. Aaron Enright's my contact over there. He's our account exec, so I talk to him all the time about different scenarios, and it's actually really good. We can just fire over 12 months of bank statements or the scenario, and he can pretty much give us an answer right up front as to what we can do, and we go from there. So Catherine will be doing the presentation. Aaron will kind of be on and off if we need him, and then we'll go from there. So I think Catherine's going to mute everybody. So if you have any questions, just go to the chat option, type it in, and we'll go from there.
Thank you so much, David and team, for having us and inviting your partners today. We are going to talk today a little bit about what is non-QM. You may have heard that term in the market. What exactly is this alternative lending called on non-QM? And we're also going to give you a little bit of an overview of what the market looks like when it comes to the non-QM loans, who indeed needs these products, who is being underserved in the conforming arena, and how can we help them. The last of the presentation and the bulk of the presentation is going to be all about solutions that David alluded to. The team here, David and team, is going to be able to look at borrowers from an alternative way in calculating their income outside of what your normal agency, Fannie, Freddie, and your prime jumbo loans require him to do. So once again, we will take some questions at the end. So make sure if you want to put them in the chat box as we're going through, you can certainly do that as well. So what is a non-QM loan, or what characteristics places a borrower or makes the loan alternative financing? One of those items would be expanded debt to income ratios. David and team can attest to the fact that normally with your Fannie Freddie, your government, your traditional, if you will, financing, capping borrowers around that 43 to 45 DTI mark. Here you have some expanded ratios available for borrowers who are creditworthy up to that 50%. The other characteristic used quite often in a non-QM program is the extension of terms. We have a 40-year term. We know there is an affordability issue right now, especially those first time entering the housing market with your price rises as well as raising rates creates an affordability storm. So the 40-year term can often be effective for those borrowers. The non-QM also gives you the ability for an interest-only loan. This comes in quite handy for investors when we're looking at the cash flow of their subject properties. That interest-only certainly can increase the cash flow for those investors. Mortgage insurance, or no MI as they call it, may have heard it called PMI or MI or mortgage insurance. In the conforming arena, you may or may not know, anytime a borrower puts less than 20% down, they have to pay an insurance premium. That is not to insure their home, it's insuring the lender in the event of a default. With non-QM loans, there is no PMI or mortgage insurance charged to that borrower, so that expense is gone. The highest use and the biggest reason for the use of the non-QM or alternative financing programs is flexible income sources. As David described to you, often he gets tax returns in, and Fannie or Freddie will call for a 2-year average. And as we know, we were indeed in a pandemic a few years ago. And depending on what state you were in, really depended on could those businesses open and what capacity could they open at. So there were definite losses of income 2 years ago. Often that average is creating an affordability problem for those self employed borrowers. So we're going to talk a lot today about alternative ways David's going to be able to qualify borrowers in particular situations. The last characteristic of a non-QM loan is that it is manually underwritten. What does that mean? With Fannie and Freddie loans, your conforming conventional loans, your government loans, they are run through AUS, Automated Underwriting System. Fannie Mae calls it DU. Freddie Mac calls it LPA. The software program is analyzing the risk of the borrower and telling the originator or the lender whether that is an approved eligible file or an accepted file. So you don't have a human analyzing the risk level of the borrower. Of course, those files still get looked at by an underwriter to verify that the data put into AUS is indeed legitimate, that achieved that approval, but there is simply not any sort of manual looking at the risk level, the story, if you will, or the attributes of that particular borrower. So the fact that you don't have a computer system underwriting and determining on the front end whether that is approved file, you get an underwriter who can actually look at the qualities of a borrower on an individual basis. Non-QM is one of the areas of mortgage origination that is expanding. We don't have to tell you the market has contracted. We all feel that, right? I mean, the numbers are all over the place. Um, your purchase money's down, your refinance is down even greater. So mortgage originations overall are light. So, if we look at the fact that non-QM is growing in a market where originations are light, I think that really exposes the need to serve some of these borrowers. Non-QM expands because there are more self-employed borrowers in our country than ever recorded before. So if we have more self-employed borrowers and these borrowers have a great tax strategy and they net their income down to where it doesn't show enough to qualify for that mortgage, they are indeed coming over here and applying for these alternative financing loans. The other reason we feel like non-QM continues to grow is because in a market such as we're in, where volume is contracted, originators have really been adapting this non-QM strategy. I am literally on calls, hour after hour with these products and introducing them to the market. So, kudos to David and the team for adapting, educating themselves on product outside of, those vanilla, if you will, or traditional mortgages that are out there. When we have the ability to serve one of these borrowers who are currently being underserved and perhaps say yes to a borrower that others have said no to, why wouldn't that strengthen uh, your relationship with your originator as well as your relationship with your client? And generally speaking, we know like borrowers refer like borrowers. That self employed borrower will probably know more self employed borrowers. So it can really help you strengthen and diversify where you're getting your sources of referrals from. I do want to talk about the credit quality of the non-QM borrower before we go into solutions, because I think it's important if any of us listening were originating or selling real estate in the industry or owned a home during that foreclosure crisis, we like to call it, of '08. You may think of subprime as that non-prime borrower. And if we fast forward into 2022, this is not a subprime product or a subprime borrower. These are well qualified borrowers who are simply being underserved when it comes to agency guidelines as well as those prime jumbo guidelines. They have great FICOs. The weighted average nationally, that's what WA stands for, national average of these borrowers is 742. I think by anybody's description, you would say that is a great FICO score. Their average loan to value is 70, meaning if they're purchasing, they have a good amount down, 30% down. Or if they're doing a refinance, they have a good equity position. We know borrowers have more equity in their property currently than ever recorded. Their weighted average debt to income ratio is 33. So that's even below that 43 to 45 that you see agency capped at. So why are these 742, 70 loan to value, 33 debt to income borrowers over here paying a slightly higher premium in the non-QM mortgage arena? Well, 51% of the time, it's simply because they're self-employed borrowers who have a great tax strategy and they net their income down. Or it's that situation that David described where agencies want me to average my income for 2 years. Well, goodness sakes, 2 years ago we had a pandemic, right? That's going to bring that weighted average of that borrower down. So these self employed borrowers are the largest demographic of the borrower that's utilizing the non QM product base that David and the team's going to offer your clients. The second highest underserved borrower in the conforming and prime jumbo arena is the investor. The investor has the same exact uh, problems, if you will, as a self employed borrower, right? 2 years ago, again, depending on your state regulation, there was what? There was rent reprieves, right? You didn't have to pay rent. Your self-employed borrower, excuse me, your investor, may require that 2-year average, and that could bring down that income that they're reporting to the IRS. In addition, investors have a great tax strategy in general in any time, not just during a pandemic, but as an investor, I have an opportunity to take all my legal deductions on that investment property and net my income down. And that often provides an issue when they go to get a Fannie, Freddie, or a prime jumbo loan. So we're going to talk about how to solve these problems for these investors as well as your self-employed borrower. First solution we're going to talk about is the largest used program in the non-QM arena, and that is called the bank statement program. This is the program for that self-employed borrower who wants to use their bank statement deposits in lieu of using their tax return. So the concept here is we're not going to underwrite or calculate that borrower's debt to income ratio off of what they've reported on the tax return that's not even submitted. Underwriters don't want to look at it. What we're going to do in lieu of that tax return, excuse me, my apology, I went one too far. We are going to look at 12 months of their personal or business bank statements, look at eligible deposits in there, and calculate what that borrower's income is based off of what they're depositing into that bank account. You can use personal bank statements or you can use business. We can't combine the two. It's going to be one or the other. We're going to use one set or the other of those statements. David could use multiple accounts. Sometimes business owners have multiple business accounts or they have multiple personal accounts, and that's okay if we need that in order to help that borrower with their home ownership goals. There is no tax documents required. So no tax return is submitted. So therefore, we don't have to verify that tax document with the IRS. On a conforming loan, a prime jumbo loan, on a government loan, your traditional loans, the lender has to send a form to the IRS called a 4506 and verify that the income documentation presented to the loan officer is indeed the same one they presented to the IRS, right? Just a fraud prevention measure. Well, we don't have to do that. Sometimes this time of year, that can get backed up a little bit. right? During tax season. So we're again not using tax returns, so we no longer have to pull that form. We're relying on meeting the borrower's ability to repay by looking at the deposits within that bank account. Now, once your borrower sends those bank statements over to David and his team, they can have that income calculated for you within a 24-hour time frame. So, just like any other borrower that you send to your loan originator to qualify, they're going to look at that income before they tell you the purchasing power of that borrower, right? We want to get those bank statements, get that income calculated so that we understand based on the deposits in that account, what can that borrower purchase? The program does allow up to a 90% on purchases. So remember, there's no mortgage insurance. So there is that lighter down payment option available for those in the higher FICO range. Your loan amounts start at 100,000 and could go all the way to 3 million. So if you're an agent who is someone who's has those jumbo listings, right? We know Fannie and Freddie and your conforming products as well as your government have certain loan limits, right? And if the borrower exceeds that, now they got to qualify under probably what anyone would deem more stringent guides on the jumbo side. So here, you've got a solution for those jumbo borrowers who do not want to use that tax return as income and want to use the bank statement alternative all the way up to the 3 million. Now, it doesn't matter what the intent to occupy is when it comes to using the feature of bank statements. There's no limitation saying, well, you can only use this alternative if it's primary. No, you can use this whether it's owner occupied. I intend to own this as my primary residence, whether I'm purchasing this for a second home or whether I am purchasing this for an investment property. From a property standpoint, of course, your standard, PUDs, your single families, townhomes, et cetera, qualify, but it also does a lot for that 1 to 4 unit as well as condos. And if you're an agent who is in the non-warrantable condo situation where we have a condo listing, it doesn't meet those agency guides, there's an opportunity here in the non-QM space to finance those condos that Fannie and Freddie otherwise deem as non-warrantable. We're talking a lot about purchase money here because, that's what you do. You sell property, but just know David and the team can use these products for rate and term refinances as well as cashing borrowers out, right? So sometimes your clients may be asking you about that, or investors often like to do what? Cash out one property and buy another. So just understand that it can be used across the board. I also want to talk about a borrower who's self-employed who has dual income. You often run into self-employed borrowers who own rental properties as well. I may own David's landscaping, but David also has 4 rental properties, and David does not want to submit his tax return. He has a great accountant, he has a great tax strategy, he writes that off, and it creates a problem from a conforming standpoint. He can use bank statements to document both those incomes. So, bank statements to document the rental income, bank statements to document the self employed income, combine those two incomes and make that transaction work. So these are the kind of solutions that the team is going to look at for you as you refer your borrowers over to them that may have challenges or being underserved. The next solution I want to talk about is asset utilization. Asset utilization gives a borrower the ability to use their assets as income without being of retirement age, without having to liquidate that asset. They get to leave that asset intact. They don't have to take out any sort of monthly snippet. We're simply going to do some math on that asset and use it as income to attempt to qualify that borrower for their mortgage. Now, there's a couple of ways that the team will be able to use this asset utilization feature for you. One could be as a standalone. What does that mean? there are borrowers out there who cannot meet your standard employment requirements of the mortgage arena, right? We know self-employed borrowers have to be self-employed for 2 years in order to utilize their income. Well, what do we do with that borrower who is self-employed 9 months, or that borrower who converted from a corporation? Now they went to an LLC, or they went from an LLC to a corporation. Mortgage underwriters deem that as a new business. It's a new structure. And a lot of those borrowers fall out of agency guides. Or we have borrowers who have a good net worth, but they're simply in between jobs. Or we have borrowers who have a good net worth, but they're brand new on a commission job, right? We know variable receipt of income needs to have a minimum of 1 year. So they're shut out or undisturbed in the conforming arena. With the asset utilization feature, if that borrower has enough assets, they can qualify without any employment verification, without any income verification, or without looking at their debt to income structure. We're simply looking at their net worth based on their checking, savings, money market, stocks, bonds, and retirement accounts. And remember that borrower gets to use that retirement account as income, even if they are indeed not of retirement age. So that's what we mean by non-liquid assets. Okay, right? If I'm not of retirement age, that retirement fund really isn't liquid to me. I can't get to all of it. So, great program for borrowers who may be running into employment challenges as a reason that they are shut out of agency or prime jumbo guides. The other way to use a borrower's assets as income is to supplement or augment their other income. Maybe I've got a retired borrower. I'm on a fixed income. I get Social Security, um, creating a debt ratio problem, but I've got heavy assets I've saved, right? I've got money in the bank. We can do some math on those assets, add it to the retirement income that the borrower's already receiving, and solve DTI. It could be that we're doing a bank statement loan we just talked about. We get that income back, and my goodness, the borrower still has a 53% debt ratio based on the bank statement income, right? We know we need to be at 50. If that borrower has assets, we could divide those out, add it to the bank statement income, and try to solve their issue with their assets. Now, this is a loan that requires a 660 FICO. We're being responsible here. We want these borrowers to have a good FICO score if we're going to entertain the alternative financing feature of asset utilization. You can still go to 3 million. Often that jumbo borrower has assets, right? And especially now, they don't want to move them. They want to get a mortgage, creates another deduction for them, great on their tax strategy, and they have heavy assets. So that cap still is at that 3 million. Property types are still the same. We're not restricting a borrower on that property type. It's the same as if they were documenting their income in any other way. It doesn't matter whether it's owner occupied, second home, or investment. This feature can indeed be used to help that borrower. Loan to value is 80, meaning they do, if we're using assets as income, need that larger 20% down payment. Generally speaking, if we're going to use assets as income, these are not borrowers where the down payment is the challenge. The challenge for these borrowers is either I don't meet the employment rules, or I'm not showing enough income, whether that is through traditional means of my tax return or W 2, or whether that's through that bank statement feature. So, great opportunity here. And once again, purchase or rate and term this can be used for. So another good feature, just another solution that David and the team's going to be looking at before they tell anyone no. Last product we're going to go through with you is called a debt service coverage ratio loan, better known as DSCR. You may have heard of this as a cash flow only loan. What a debt service coverage ratio loan is, it's for investors. This is a program for someone who's purchasing a property as an investment. They're not going to live in it. They're not going to buy it for their daughter. They're not letting family members live in it. They are buying this as an investor. They want to rent this property out. Once again, if they cannot qualify from a conforming standpoint, the next best execution would be to go to a DSCR loan. We don't verify any employment for these investors. There's no income verified for these investors, and there's no debt structure personally looked at for the investor. Your ability to repay for this loan is based off of the cash flow of that property. So, can that borrower cover their proposed payment on the subject property with the gross rental income calculation on that property? If I can cover my proposed payment on the subject property with the gross rental income that I could potentially collect, then that's how we meet the ability to repay. I've got to cover that payment by 100%. Now we get to leave employment income and that investor's tax return and debt structure out of the equation. So how would we come up with that gross rental income calculation? What does that look like? If you have an executed lease agreement on that property, you use lesser of the lease agreement or the market rent from the appraisal. If there is no lease agreement, you're using the market rent from the appraisal. Anytime you do an investment property, there's an addendum. Fannie calls it 1007, Freddie calls it 1025. We love our numbers in this business, right? And it's an addendum that compares the subject property to other properties in your area that are currently rented and tells us what is the average rents that this property can bring in. That's what we're going to use. If the property's already leased, it's lesser of the two. But it could be vacant. It could be you have an investor purchasing somebody's second home. I could be an investor purchasing somebody's primary, and I'm turning that into an investment. So in that case, we're just simply going to be going off of what that appraiser says the average market rents are. That average market rents cover that payment by 100%. That's how we qualify the borrower from an ability to repay. There is an opportunity to sell an interest-only loan to investors, and it creates more cash flow for that investor. And the loan officer has the ability on a DSCR loan to qualify the borrower off of the interest-only payment plus the escrows. So that could make the DSCR even higher. It helps sometimes if that DSCR comes in under coverage, right? My pity's 1,000 and my gross rent's coming at 900. I'm off, right? I'm upside down. Well, maybe if we did an interest only loan, now we divide the gross rental income by the interest only payment, getting rid of the P or the principal. That's why it's in bracketed. And that can sometimes help make that loan work. So, great opportunity here for investors to qualify. On a refi, and often investors are cashing out. We see it all the time. They're cashing out their current properties and purchasing more. If you have a refi and there's an executed lease agreement on that property already, if the borrower can provide 3 months receipt of the higher rent, we'll even let them use the higher rent to qualify. So there are a lot of ways to make this DSCR ratio work for those borrowers who are indeed in the investment arena. Now, the FICO 660, once again, we are being responsible, right? We want to make sure the borrower has the ability to repay by covering that payment by 100% or more, not doing properties that are underwater, if you will. And we want a reasonable FICO. 660 is a good FICO. I mean, all the statistics say above that FICO, they perform quite well. Delinquencies are lower. There's no personal income qualified, so we don't have to gather any income on the borrower. Remember, they do need at least a 20% down payment. Loan amounts here still start at that 100,000, and they still go as high as 2 million for some of those high cost, if you will, areas. Still can do the up to the 4 units in the condos and the non-warrantables, right? Of course, you can do single family PUD townhomes, right? Traditional properties as well. Remember, it is for investors only. The occupancy must indeed be that borrower is purchasing that property to rent out. It is not their primary residence. It is not their second home. It's an investment. Of course, the property when they're purchasing could be vacant. That's okay. There's nothing saying that property currently has to be utilized as an investment property to qualify for this. Somebody could be purchasing a vacant property, somebody's second home, somebody's primary, right? So great opportunity to look at some of your listings, look at the average rents by going to rent.com or Trulia, and get at least a preliminary idea if that property will indeed cash flow. As real estate agents, you probably know just as well as appraisers what the average rents are bringing in your particular market. So opportunity to advertise these listings and open up some more potential buyers by using the DSCR cash flow program. So thank you. We do appreciate you giving us that time today. I want to go ahead and say if you'd like to come off on mute, there is that.
Thank you for joining Team Duplicity, and we'll see you next time.